This is Let's Talk Energy, your go-to podcast for smart energy insights. I'm your host, Noah Brenner, and each week we're bringing you an inside look at the dynamics shaping global energy markets through in-depth conversations with our own Rystad energy experts, as well as some special guests. In today's episode, we're dusting off our crystal ball and gazing ahead to what we believe will be the biggest energy stories of 2026. How will companies and countries navigate oil, natural gas, and power markets that, on a macro level, are forecast to be significantly oversupplied through the year ahead? Could 2026 be a pivotal year for the energy transition, despite worries about waning climate ambition globally? And finally, will geopolitics inject even more unpredictability into an already tumultuous energy landscape? To help us figure out what the year ahead may have in store for the energy industry, I'm joined today from Oslo by Jarand Rystad, founder and CEO of Rystad Energy. Jarand, welcome to the program.
Thank you. Great to be here.
Well, let's talk energy. We're starting to see the wave of 2026 predictions about the energy market and what could be in store for the industry, including you'll hear some from our show today. But Jarand, I wanted to start out with what's your most contrarian prediction for 2026? What are you hearing out there that others say might happen that you don't quite agree with?
We think that it will be abundance of energy this year. We see a lot of new oil coming in, a lot of new gas coming in, and a lot of new power coming in. So some people are more cautious and still are living in a world where they see scarcity of energy supply. So, but we have the opposite view, at least.
Let's talk about some of Rystad's numbers here. I mean, oil, we're seeing about 800,000 barrels per day, I believe, of demand growth. That's less than 1% of total global demand, and about 3.2 million barrels per day of supply growth. And that's assuming that OPEC does go ahead and unwind cuts. And we'll talk a little bit more about that later. I mean, that's another 3% of global oil supply. Natural gas, we've got demand at about 45 million tons per annum, to put it in LNG terms of demand growth. We've got supply growth equaling about 60 million tons per annum, and that's split between LNG and pipeline gas. And then in power, we've got demand growth of about 900 terawatt hours, I believe, with supply growth at about 1,100 terawatt hours. And a lot of that's wind and solar. But again, supply growth 20% above almost demand growth. So I see the abundance. But I think a lot of people don't necessarily feel the abundance. Politicians and the public are really worried about a crisis of affordability. And so why doesn't that upstream abundance necessarily translate into lower prices that consumers are paying?
Yeah, let's start with the United States then. There you had last year, you had power prices down to $30 per megawatt hour. I mean, for the spot prices, of course, consumers will see some cost added to that. But today it's $42. So clearly it's higher. And that's why it's two new sources of gas demand in the US. It is data centers requiring a lot of gas for power production, and it is the new LNG facilities. We have seen the Henry Hub price that was in some months last year, 2024, it was down to $2 per MMBTU, and this year and just recently now it's up to $4.2 per MMBTU. But in one way, I could say that Americans are a bit spoiled from being used to very cheap gas prices. And they even feel that increase from average $3 last year, but to now 4.4. Then they feel the higher prices when they're using gas for heating, or gas is then influencing the power prices, as I just mentioned. In Europe, we see completely different prices. We see $11 per MMBTU, and people are very happy now that it's approaching $10. So they see the declining gas price, and next year we expect a further decline of the gas prices, maybe to 9.5 or something. For Europeans, and also for East Asia, these prices are attractive prices, even if they're 2 to 3 times higher than in the US.
Have we done a very good job, perhaps, of solving for the upstream part of the energy equation, and maybe not as good a job solving for the midstream, downstream market part of that equation? Is that a fair assessment, do you think?
Yes, it's very rich supply on the upstream side, but there's quite some bottlenecks on the downstream side, and that bottlenecks could be on the oil side. It could be on refining. We have quite high diesel cracks now, quite high diesel margins, and even influencing the gasoline margins. But also on the power side, of course, we have not enough storage. So with all the intermittent renewables, we get very volatile prices in the middle of the day. We can have zero cost of electricity. Basically, we're drowning in electrons, and we have even negative prices. But in the evening, we could have quite high prices then when the sun is no longer shining, and especially then if the wind is not blowing very much that day, then we could see very high prices. There is clearly bottlenecks on the storage side, and this is driving prices up and down. But on average, since 2022, of course, we really had a energy squeeze. We have seen all the prices trending down. And also in Europe, in many countries, prices are linked to the gas price. And for example, in the UK and in Italy, we have the highest prices in Europe, which is because it's linked mostly to the gas price. But also there has been slightly trending down. But in countries like Spain and Germany and partly France, which is much more influenced by solar, we have seen very low prices, especially in the spring this year, because a huge oversupply of electrons. And next year, it will be even more of that.
Let's dive in on oil. I think this has been perhaps the most discussed oil glut, the most forecast oil glut in history. We've been talking about it for probably more than a year. But at the same point, we've also seen a major shift from OPEC Plus producers group in terms of its strategy, prioritizing perhaps market share, at least to a greater degree than price. And we've also seen shifts in corporate strategy when it comes to the U.S. shale players, prioritizing returns to shareholders, capital discipline, and not reinvesting at rates that are above their cash flow. And so, what I'm wondering is, I mean, essentially, the amount of oversupply that could be in the market doesn't even fit in global storage, if I'm understanding it correctly. We don't really have the physical place to put all this oil, so something's got to give. Do you think that we'll see OPEC or U.S. shale balance this market? I mean, who's going to cut first and how much, maybe?
The US shale will be quite resilient. I think it will be fairly flat at the current levels. That's the latest figures we have from our shale team, which has usually been very spot on what has actually happened. So I have a lot of trust in those analyses. I think you have a third option as well, that is China building even more stocks because they have expanding their ability to store crude quite much recently. So this year they have taken a lot of the surplus crude in the market, and I think they will continue to do so next year as well. But also I think OPEC will not bring the 1.4 million barrels back to the market that I think has been their initial intention or the intention that they've communicated this year that they will do next year. I think we're more likely to see them stay at the current cuts. And when you're using this figure of 3.2 million barrels of growth, then you have already then included about 1.4 million barrels of comeback from the OPEC countries. So I think they have to give in a way, as you ask about.
I want to talk about gas markets. Again, also tilting towards oversupply in the year ahead. I mean, you mentioned that this is really good news potentially for Asia. It's certainly good news for European consumers. How does this position gas relative to coal and renewables, particularly in these emerging economies that you've referred to? I guess, could we see 2026, maybe 2027, push some countries to add more gas into their energy mix because it is affordable? And could that in turn lock in a more future demand?
It will be more coal to gas switching because this is a continuum, it's for slightly lower gas prices. For some decision makers, it will then make sense to switch from, if they have a portfolio of power plants or even at the same power plant in some cases, they can switch between those two fuels. And they will increasingly shift from coal to gas in all places globally, except from in the United States. Then we are likely to see the opposite thing happening, actually, that we could see more switch from gas to coal due to increasing gas prices in the US. So that's the opposite situation there. We have seen that already this year. Coal has increased in the US. But we also have the main structural trend, which is much more renewables. And surprisingly now, not only China, but also India has seen a decline of coal and then fossil in the thermal generation due to much faster than expected growth of renewables. So we have used to see this pattern from China, but this year, I just looked at the figures, 7% down so far this year in India also. But it's also related to the weather events. They had a quite early start of the monsoon season in India this year. So weather events that is not kind of will be repeated every year. But also this is the structural trend. Those two things working together, taking down coal consumption in the power sector by 7%, which is quite extraordinary because the expectations was that will continue to grow for many years in India, actually.
We believe the world will reach, if not more, kind of critical inflection points. If they haven't sort of to the end of 2025, it will happen in 2026. And this is China's reliance on thermal power declining year on year for the first time ever, I believe. And as well, we predict no net growth in fossil fuel generating capacity globally. And that's because new fossil capacity is being offset by retirements. So can you put these developments in perspective for people? Two kind of big trends we're seeing flip right at this time. Why are they important, and what does it tell us about the global energy system?
We have about 1,100 terawatt hours, as you already mentioned, of new electricity coming in 2025, and similar figures for 2026. And let's see, we are not yet reached the end of the year, and if it becomes some extraordinary cold weeks in China the next weeks, we could still see slightly increase there. There's just on the margin, they are flat or maybe negative development in thermal generation. So I think it's quite extraordinary now to see that all the addition will be from renewable sources. Most of that, more than half of it, is solar, and then it's wind, about 30%, and then it's some geothermal and some hydropower and some biomass coming in. This is just illustrating that we are reaching a plateau in terms of thermal power generation globally. And that could last for a few years, depending on the economic cycles, etc. So maybe go a little up and down, but then structurally it will start to decline. The thermal generation will start to decline then in a few years from the structural reasons, from basically seeing much more renewables being added. On the renewable side, we're also reaching some inflection point where we could expect some years of less growth because you're reaching the saturation in terms of what you can absorb from what kind of flexibility you have in the rest of the power system. And just now we are lagging on the storage side. So we really need to build more storage to be able to include even more renewables in many markets. And even in the biggest markets, we see that in China, and also in Europe, we see that. But then it's encouraging then to see that a lot of the new capacity coming in now is actually battery capacity, which will create this new flexibility. So we have seen this extremely steep renewables. I expect that to be flattish for a few years before you get the new growth, because we need to balance this by all this by storage, and as I said, there's a lot of new storage coming in. In Europe, it's actually more storage than solar coming in for the next years, which is the first time ever.
It's really a really interesting dynamic. And I want to use that as a jumping off point to talk a little bit about geopolitics, because battery supply chains, I mean, even more than some of the other green technology, transition tech, electrotech, whatever you want to call it, technology is really entirely controlled by China. And so, do we think that economic, geopolitical rivalries between the West and China could limit this global build out of battery storage, particularly in the couple of years ahead?
I think that is already cells that are produced and are ordered and a quite kind of settled supply chains to get those in place. Longer term, of course, since China is so dominant here, it will take time to replace that if some international or geopolitical events should happen that is really cooling down the relationship with China. The technology will be there, but it will take time to develop the capacity. And basically, I think that the OECD countries has not really taken up the competition and facilitated their own industries to respond to this dominance by China. They have rather just let China be very dominant on this and really not challenge them really on the competition side through policy measures in their own countries.
Which of these could materially change your outlook, I guess, if they were to occur? Let's start with a peace deal in Ukraine. How could that change your 2026 outlook?
That will lead to even more supply of oil, I think, because we will rather let Russia export more than let them get territorial claims. So, but I think it's not likely to happen. Actually, I'm not too optimistic. I think it will be another 2, 3, 4 years of freeze, and then you will basically land on some kind of current border, current front lines freeze. That's what we have seen historically in similar conflicts.
Would it change anything if we see some kind of major climate-fueled disaster? I mean, I'll say a natural disaster. Could that potentially refocus the world's attention on climate, which many have said has kind of drifted over the past, say, year or so?
We have seen an increase. Just the statistics is that we had about 180 major climate-related events from 1980 to 1999, and we have had about 360 since then per year. So it's doubled, but it's not enough, I think, to create the headlines needed to make a shift. You have already focused a lot, and of course, the main trend over the last 2 years has been less attention, despite many quite serious climate-related events.
I want to talk about a trend that you identified earlier on in the program, which is AI. I would say probably the hottest topic in energy, perhaps right now. But where that AI, what the direction is, the trajectory is, maybe there's quite a bit more discussion. Some warning of an AI bubble, others saying we're actually underplaying how impactful this could be. So what are you watching in the AI space in 2026 that'll help us understand these future implications for energy that seem quite cloudy right now, I guess?
Yeah, just let's say that we have just completed this, database, 13,000 data centers, mapped them bottom up, and they are today they are consuming 112 gigawatt. Next year, on average, it will be 150. So it's a growth of like 36% or something, and it's going to grow as much the next year, approaching 200 actually. So clearly, this will also require much more energy. You really feel kind of the pain or the challenge of that is in the United States, because you have a very aggressive build-out of AI. A lot of this is, however, done behind the meter, is done with stranded gas in Texas, in Permian, some places, etc., and with a combination of solar, car batteries, and stranded gas. Then you can actually access very inexpensive energy without influencing the broader power market very much. But more in Virginia, where we have the other AI hubs, I think it's actually influencing the power prices. And so this is going to create some increased demand in some places where there's already some scarcity, and will influence power prices those places. Globally, however, it will only be 10% of the total consumption growth. Electrification of transportation and air conditioning is actually bigger sectors of growth than AI if you take the global view.
One of the areas you've highlighted as a potential opportunity for companies in the year ahead is M&A. If we have a glut of energy and we have lower prices, that can be a good time to pick up assets if you've got a long-term view. But that's only for those companies that have the financial ability to do so, and the strategic freedom, I guess, to buy low and wait for the rebound. So, can public energy companies do this? I mean, will investors support spending for growth if that potentially threatens these shareholder returns, the dividends and the buybacks that have really driven a lot of value in the energy business? Or is, say, private equity or national oil company, NOCs, are they better positioned, do you think, to take advantage of some of the M&A opportunities? How do you see that competition?
We expect that after 2026, we are going into a new cycle. So oil prices will go up again, and gas prices, however, are in a longer down cycle actually due to a lot of new LNG coming in. But I think there will, so really 2026 is the year of big opportunities if you have deep pockets, like you ask about. But also I think one of the driver is that just to take out cost, it will also be some cost-driven mergers that we will see with the purpose of merging different operational units and take out a lot of cost. And this could be kind of a shock that is happening next year that could defend the kind of the management's kind of ambition to do these mergers and take out the 20% cost, for example, from the organization. So expect that to happen as well. And we're seeing increasingly now also other drivers that international oil companies want to make joint ventures. That's a new big trend with national oil companies to cooperate on field development where the IOCs have the capital and they have the competence and the NOCs has the resources. Of course, increasingly also the two other resources I mentioned, but yeah, so this will also, I think we can expect actually quite much on the restructuring side and on the M&A side next year.
Does the hybridization of the energy system that you and others have talked about, the increased competition, does that change the way that these, particularly oil and gas price cycles work? And they've been so key to long-term value creation, as you pointed out, particularly in our last conversation in August.
Investment cycles will continue to exist. And they are a bit different in oil and gas. It's slightly longer cycles in gas, especially now since LNG will be the new oil in a way. It will be the new global traded commodity, and those cycles are much longer. So that's why we are now going into a longer down cycle for gas, maybe lasting all the way till 2030, 2032. And then we will have a new upcycle, I think, for gas in the late 2030s. People will use gas more and the infrastructure will be built to consume it. And then you will suddenly go from oversupply to undersupply, probably on the mid-2030s. So that's the gas cycle. But these investment cycles will continue to exist even in a declining oil market. Also, a lot of the investments in oil is related to the well level, maybe $200 billion. And those investments are to arrest the 15% decline in the oil market. So if you then use, let's say, to oversimplify a little bit, $200 billion to get back 50 million barrels per day, it's only 10% more to have a 2% growth or 10% less to have 2% decline. So that doesn't matter too much. So the investment cycles then with the price signal will continue to exist even in a peaking and a declining oil market for the next 2 to 3 decades.
I want to take a step back and broadly talk about energy demand. And this is an area you know much better than I do. So certainly correct me if I misspeak here. But I mean, if we look at all of energy demand and we subtract for losses, so the energy that's wasted due to inefficiency, and then we take out the molecules that are used to make products, so petrochemicals and plastics and everything that we rely on that's made from fossil fuels, we see electricity demand growing about twice as fast as fossil fuel demand, I believe, if I'm doing my math right. So could we see 2026, I guess, as an inflection point globally in this question of energy transition versus energy addition? I mean, are we really kind of shifting into that transition phase?
Yeah, I think I just described how that is happening in the power sector. And in the power sector, it is actually happening just this year or next year. You know, we are at the plateau. For the entire energy sector, it will be another 5 to 10 years until we see that. You mentioned very precisely if you're taking away the molecules used for plastics and materials, which is actually more than half of the oil growth. So oil is now growing more as a part of the material system than as a part of the energy system. But for upstream producers, they don't really think about that. So of course they see the oil consumption growth of 0.8 or maybe 0.9 over the next years. So looking at this, yes, the pattern we see in power will be repeated for the entire energy system, but with a lag of 5 to 10 years.
Just come back to this affordability question. I mean, I feel like it is really an important driver of, some of the retreat that we've seen in climate ambition. You argue, and I don't think anyone would disagree, that in the year ahead, these decisions will be driven more by fundamental economics than policies. And so what does this mean for the pace of the energy transition that we've just talked about in 2026? Do we see this, I guess, accelerate or slow if economics are the core driver rather than policy?
Some of the sectors will be slightly slowed down, like some of the electrification. I mean, places where you have had incentives to buy electric cars, and that is taken away. That will then lead to a slower growth. However, in many markets already, an electric car will offer lower cost of ownership. So then you will continue to see the same pace going forward. But the net effect of being less supportive policies for the energy transition will be slightly slower, but not at all a full stop or a reversal like some people are thinking. It is still, solar, batteries, onshore wind. The business cases are so strong, and the competition from traditional fossil fuel in terms of new investments in those sources, it's no longer competitive. So that is not likely to happen as a base load. In some places you can have it as peaking plants, for example. But I think still the fundamentals now are, the economic fundamentals are driving steadily the energy transition forward.
Jarand, thank you so much for dusting off your crystal ball, your crystal snow globe, I guess, given the season for us and having a look at 2026. Before we sign off here, and perhaps I'll sign off for a short winter's nap here heading into the holiday season, what are maybe, I don't know, one or two Christmas traditions that you're really looking forward to celebrating with friends and family here in the weeks ahead?
A traditional Christmas dinner with my whole family, with my two sisters. I have a brother also, but he's going to Bangladesh to visit his daughter this year. But that's always very important meals. All the people coming home from being abroad, etc. My three sons, etc. But also we always have a lot of cross country skiing in the Christmas holiday. So I look forward to do that as well.
And lutefisk, the great Norwegian holiday
we
tradition?
We have some traditions on that, but never for Christmas Eve. Then we are eating actually pork belly. So,
well, excellent. Jarand, thank you so much for joining us.
Yes, thank you. Very nice to be here.
Let's recap. Oil, gas, and power markets are all tilting towards oversupply, and consumers in Europe and Asia are likely to feel some relief from high prices in 2026. But not in the US, where relatively higher natural gas prices could continue to pinch consumers. Battery storage should be the big winner next year, and despite rising trade tensions between China and the West, orders for the next year are locked in and shipping, and so any threats to growth from trade barriers are likely to be felt further out into the future. In the year ahead, companies could take advantage of lower energy prices to snap up competitors or team up through joint ventures. But such deals will favor those with deep pockets and patience, whether those are public, private, or nationally backed companies. Thanks for listening to Let's Talk Energy. This podcast is a Rystad Energy production, produced by Laura Rodriguez-Skaug and Bada Og. Check out the show notes for further analysis on the topics that we've discussed today, and connect with us on social media. We're at Rystad Energy on all your major platforms. You can also keep up to date on our website. If you'd like to send us questions, or maybe you've got an idea for a future episode, reach out directly. It's podcast@rystadenergy.com. And this is our last episode of the year, as we'll be taking a short break for the holidays, so please join us on January 14th for more Let's Talk Energy.